Hey everyone, my name is Anthony Fatsis and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming on Justin Huhn. So Justin is the founder and publisher of Uranium Insider and an expert in the field. So Justin, thanks so much for coming on the podcast today.
My pleasure, Anthony. Thanks for having me.
No problem. Looking forward to the conversation. Yeah, it's the first time we've spoken and we haven't really had anyone who's sort of an expert in uranium or speaking specifically about uranium. So really interested in this. But I was wondering if you could maybe just lay the groundwork, like, very, very broad overview of what is the uranium market? How is it driven? And yeah, what are the key dynamics that you watch?
Sure, 30,000 foot view. So uranium is the fuel source for nuclear energy, first and foremost. It also is the source for highly enriched uranium that's used for weapons grade, nuclear warheads. But the market that we're focused on, and the primary market for the mined metal of uranium, is nuclear energy. It's a very, very unique commodity in that it functions in a similar manner as most commodities, which is very cyclical. You go through extreme bear markets into extreme bull markets, and um, you know, low prices are the cure for low prices, high prices cure for high prices, right? To quote Rick Rule. These sort of things always happen for most commodities. The interesting thing about uranium is that the cycles tend to play out a bit longer because of the very, very slow response time of the mining industry to respond to incentive pricing. And it's not just the complications with mining uranium, but you're dealing with a radioactive material. So there's oftentimes much more bureaucracy. There's only a handful of safe and supportive jurisdictions in the world where there's a lot of uranium mined. So oftentimes during the bear market, and because of what's known as the fuel cycle for uranium, which is the mined material, which is the actual pure commodity that goes through minimal processing to turn it into U3O8, or what's known as yellow cake. It's literally like a yellow powder in a barrel. That is then converted into a gas in order to be able to enrich it in a gas centrifuge, and it's enriched up to, it goes from natural uranium at 0.7% U-235, which is the fissile isotope, all the way up to between 4 and 5% for reactor usage, and all the way to 90% for weapons grade material. But that enrichment process, then it has to get deconverted back into a solid from a gas and then fabricated into fuel rods. And this whole process can take 1.5 to 2.5 years. So because of that slow amount, the long period of time it takes to move uranium through the fuel cycle to eventually get to fabricated fuel that is actually utilized in a reactor core, utilities, sovereigns, will hold larger amounts of inventory than let's say a coal power plant will hold it, because they'll just rely on constant shipments of the material. And because of that, you have an inventory buffer that can often carry a nuclear utility over for a period of time. So in the bear market, what you often see is the price will plummet well below the cost of production. And in the bull market, the price will go well above that incentive price. So it's a very, very long cycles, very slow to respond industry, and you tend to have an extremely volatile equities environment for the uranium mining stocks around the commodity. So, for example, in the previous bull market that went from, let's say, 0304 to 07-ish, you had stocks go up 1,000%, 10,000% in some cases, and just huge, huge, massive ramps on the equities. And the price of uranium at the time went from less than $10 a pound to $134 a pound. So it spiked, it came right back down. Right now we are in, let's see, the price of spot uranium bottomed in late 2016. So we're 9 years into the recovery of the price. I wouldn't say that the bull market began as soon as the price stopped dropping. That was more like a V-shaped recovery from $18 a pound in December 2016 to the production cost, let's say between $40 and $60 a pound, just to throw out an average. Now we're at $75 spot, $86 term, and the price needs to go higher to incentivize marginal projects. So at Uranium Insider, we've done very, very in-depth spreadsheet work to model out the entire industry, every single reactor that's operating, that is going to be operating, the expected shutdowns, expected life extensions, and comparing to that to the relatively small world of uranium mines that are actually producing, in development, will be producing. So this complex modeling gives us a pretty confident sense of a persistent supply deficit in the industry. And of course, that has existed for many years, which is why the price has recovered to the extent that it has. But now we're at this point where we see still a very, very long runway. And there's much more dynamics I can get into as far as the nuclear utilities, how they're behaving, what those incentive prices mean, what's going on with the major producers, et cetera. But to boil it all down, it's an extremely volatile commodity with very emotional investors that are interested and invested in this space. And when the price runs, the stocks can run very, very hard. And you also have steep troughs where you can see, 30 to 50% declines over the course of a month or two, which is very, very, very volatile. Um, so a lot of opportunity there in these troughs like we had earlier this year. And now we've had a very good year for the equities. And despite the fact that the spot price is basically flat, the term price, the midterm price, 3-year and 5-year forward, those are all moving up. We can get into that if you'd like. But 30,000 foot view, huge amount of electricity demand that's happening globally, really, for many reasons. But the big drivers in the West and in China have been the AI data center story. And so that's really de-risking the existing fleet. Demand is incredibly de-risked and it's growing at about 3 or 4% compound annual right now. That's the growth rate of demand for uranium based on the growth of nuclear energy. And so we think this has a very, very long ways to go, and we don't really see where the supply is going to come from. So until we get much higher prices sustained for a while and start to see a lot of projects developed, of course, the price could be double what it is right now tomorrow. We'd still need 3, 4, 5+ years to see any of these development mines actually get into production. So, in that way, it's a very unique commodity. It isn't cornered by China on the supply side or like an OPEC, so you don't really have somebody flipping a switch up or down, creating these various moves up or down in the market that are not necessarily structurally driven. So in that way, it's complicated to model, but relatively easy because of the small world that it is. That way, we can have very high confidence in what's coming, at least for the next 3 to 5 years. Beyond that, you start to have to put plugs in those models, but very, very high confidence in where this is going over that time period.
Yeah, okay, really interesting. Thanks for laying that out. If I'm not mistaken, yeah, obviously 2010s were quite a tough year for uranium, as you're saying, sort of bottom in 2016. I guess the challenge is it's not just a supply demand dynamic, it's also the political dynamics. I believe, after the Japan Fukushima, that's when there was sort of a lot of countries pulling out, and then I think Japan was selling their actual fuel. So I guess those are also the things that you sort of a challenge with. It's not just supply demand. There's other factors as well.
100%. Yeah. And the risk of a nuclear accident of some kind is always sort of like hanging over the industry. I think that's one thing that gives the investment, an extra dose of volatility. But politically, it's really done a 180. I would argue that it's more politically favored right now, to speak very generally globally, than it was before the Fukushima accident. And even Japan, the Japanese that have experienced the most recent accident, are majority in favor of nuclear energy. They're restarting reactors. They've restarted 13 reactors at this point. There's another dozen or so that are at various stages of restarting. There's only a couple of holdout countries that are kind of sticking to their guns in terms of being anti-nuclear. One is Germany, who had arguably the most efficient nuclear fleet in the world, up there with the United States and the Czechs. But they shut them all down, and now they've ramped up coal production, and energy prices have tripled. It was an absolutely insane and terrible move. Germany, Austria, Spain, and to some extent Belgium, although they're turning back. Even the Taiwanese, who just shut down their last reactor, are wanting to restart it. So part of the reason is the electricity demand growth that's happening, but of course, finally, it's getting the recognition it's always deserved as a clean energy source. So we have a few holdouts, but generally speaking, politically, it's very, very much in favor. In the United States, for example, it's one of the very few things that the Democrats and the Republicans can actually agree on. They're both pro-nuclear.
But yeah, that's really interesting. You said that sort of China doesn't corner the market. Did Russia have sort of quite a large play in, I guess, enriching of uranium, or has that shifted?
Russia is the largest player globally for both the services of conversion and enrichment. So and they have been for a very long time, and they will be for a very long time. The Chinese are building a decent amount of both, but they're growing their fleet so quickly that they're basically building out capacity of both conversion and enrichment, roughly in line with the growth of their nuclear fleet. They're wanting to be able to service their own fleet without having to outsource those services. They don't have a whole lot of in-ground uranium, which is why they have joint ventures in Kazakhstan. They've got a big mine in Namibia. They're developing mines in other countries and buying a lot of uranium as well. But on the supply side, the Chinese don't corner it. The Russians, while they have the biggest share of both conversion and enrichment, they don't have a lot of in-ground uranium either. So their best assets are joint ventures in Kazakhstan, and they are basically short uranium. They have a very large export book. The Russians do something better than anyone else, which is actually build and export reactors. So they'll go to another country. They're doing this in multiple countries right now in Egypt and Turkey and a dozen others, where they're financing a reactor, building the reactor, training the workforce, operating the reactor in some cases, or like I said, training the workforce to do so for the life of the reactor, storing and dealing with the spent fuel and the waste from the reactor, and ultimately decommissioning. So it's like an 80 to 100-year deal, and they fuel it for the life of the reactor. So being able to provide that enriched uranium fuel for the reactor exports, they still need the source material, which is uranium, and they're short of that. So they're massive net buyers of uranium. They're actually net buyers of UF6, which is the product of conversion. So despite being the largest converter in the world, they're actually net buyers of that product of that service, which is very interesting. Most people don't know that, but yeah, the Russians are pushing very hard to expand their big JV project in Kazakhstan as quickly as possible because they need that material and they need it. I don't want to say desperately, but they very badly need that material.
Yeah, okay, as you said, sort of see the pipeline in the future, and they know that they need sort of more production. So, what are the economics of a uranium mine? As you said, there's sort of, I think I've heard you listen to talk in another interview, and people you're sort of saying that a lot of these miners are waiting to try and get better economics. So, yeah, what are the economics, and why aren't they mining now, even though prices come up?
Sure. Well, the lowest cost producers in the world are Kazakhstan and arguably BHP from their Olympic Dam mine in South Australia, primarily because uranium is a byproduct of copper and gold from that mine. In Kazakhstan, they operate what are called ISR mines, in situ recovery. So it's basically uranium that's held in an aquifer in a sandstone ore body. And they inject sulfuric acid into the aquifer and they extract it, and that acid binds to the uranium. So they're producing north of 60 million pounds a year in Kazakhstan. They were producing 6 million pounds. I think they pushed 68 million pounds when they peaked in 2016. They used to be 100% state owned until 2018. And up until that point, really, they were just producing as much as they possibly could, as fast as they possibly could. And there's multiple theories on why they were doing that. The conspiracy theorists will say that they were being influenced by Russia and wanted to basically destroy the Western uranium mining world, which they did. Also at the same time, they had a rapidly depreciating currency. And so they were producing in Kazakh tenge and selling in US dollars. And so they just did that hand over fist for many years. In hindsight, it was not the smartest thing to do because they've sort of used up their best assets in a market that was very low cost. So they were producing 68 million pounds into market and selling it at 25 in the term market or $18 in spot. They're not really spot sellers for the most part, but term market 25, $30 a pound. Now the term is 86, and they're looking out into the future and seeing big decline rates in their production curve. But they produce ISR. And so based on the geology, the large amount of uranium that they have in country and the mining method, they're the lowest cost producers. And they're producing less than $50 a pound. They're less than $40 a pound cash. But if you go all in sustaining or even fully allocated costs, they're probably in the 50s. Still extremely profitable at these prices. And they're basically the lowest. Some of their projects are even substantially lower cost than that. Then you get into the other big producers, which would be Cameco and Orano in Saskatchewan. These are high grade underground mines. These are very complicated mines. They're basically mining in an aquifer, and they have to go through the sandstone in order to get to the mineralized ore, and it's just full of water. So they have freeze walls around the mine shafts, and these mines are extremely complicated and expensive to operate. But with that said, it's very high grade uranium compared to Kazakhstan or most other places in the world. So their mining costs are similar. They're probably in the 40s and 50s per pound for Cameco and Orano. Very large mines. These mines are primarily Cigar Lake and McArthur River, the two big ones that are operating currently, the two actual only ones that are operating currently in Saskatchewan. And Cigar Lake they're both about 18 million pounds a year. Cigar Lake is actually going to be done producing in 10 years, and McArthur River in 15. And both Cameco and Orano need to shore up their pipeline for projects to replace those very, very important assets. Moving past Saskatchewan, you have various projects. There's a couple of others in Australia that are ISR and open pit. They're a little bit higher cost. Then you have the Namibian mines, which is open pit, very low grade, but favorable strip ratios. So the mining isn't crazy expensive, but it's definitely a higher cost curve than you see in Kazakhstan or even Canada. And you have the Chinese operating a big mine, the Husab mine there. They're getting about 15 million pounds a year from that. There's a couple of others that are operating, a couple of others that are in the development stage. And then you get into the marginal stuff, which is more development in Namibia and the mines in the United States, for example, where you have, let's just to give you one example, there's an ISR producer currently in the United States. I won't mention the name, but they are producing at their mining cost is less than $40 a pound, and they are selling it at 65 in the last quarter and operating at a loss. So that gives you that's like the cash cost, but then the fully allocated cost, it takes everything into account. So in Kazakhstan, that would be a dividend and all of the labor costs and like everything that's fully allocated into that, substantially higher than that $40 cash cost. So we believe that even at this price right now, at $75 spot, $86 term, kind of nobody's making money besides the Kazakhs. And that's sort of a problem because demand, like I mentioned, is so de-risked and it's growing so rapidly. And a lot of these big producing companies like Cameco, and just to I'll cap off this talking point regarding the cost with what Cameco is wanting in their terms, these companies that are currently producing need to replace these assets, and the development projects that are going to be necessary to balance this market in Namibia, in the United States, and elsewhere need higher prices than where we're at now. So we would argue the incentive price is north of $100 for new large projects to be profitable sufficiently to take the financing risk to actually build these mines. And it's not a very, looking historically at the market, this is one of the reasons why some of the larger multinational mining companies are not all that interested in this sector because they primarily want to deal in minerals and metals that at least assets for the minerals and metals that can be profitable in any market, at least marginally, even in a bear market. But in uranium, that goes from $10 a pound to 134, and then back to 40, and then it does what it does up until Fukushima. Then it falls all the way back down below $20 a pound, and then it jumps to 100 earlier last year. It's extremely volatile all over the place. So it's a tough sector for these large multinationals that don't necessarily deal in uranium. With that said, the existing producers that are doing well with what they're producing are wanting higher prices. And like I mentioned, Cameco has been saying in their conference calls for the last 18 months that the contract terms that they are essentially requiring here to engage in new contracts with nuclear utilities, they want to see contracts where they will be delivering into mostly, if not entirely, reference to the market prices at the time of delivery. And they want to see floors around where the market's at now, which is in the 80s, and ceilings 120, 130, $140 a pound. So we're at 75, 85, and Cameco is saying, yeah, we'll sign a contract for 2028, 930, which is now in this market. That's when the utilities are buying right now. They're buying out into the future with these contracts. And they're saying, we want ceilings double where the price is at currently. And the utilities are struggling to swallow that pill because, well, A, that's a hell of a lot of money when you're buying millions and millions of pounds of uranium for multiple years of delivery. And B, market reference or mostly market reference in these contracts means they don't know what they're going to be paying. And that's not something that utilities are all that comfortable with, to speak generally. They would prefer fixed pricing or base escalated pricing with inflation adjustments. And if they're selling power purchase agreement offtakes for a 10-year period to a tech company or a data center, and their profit or their revenues, let's say, is going to be fixed, not knowing what they're going to be paying for fuel as a 10 to 15% of their operating budget is a pretty big deal. So with that said, they don't really have a choice, and they're going to have to pay what the producers are asking, and not because the producers are trying to stick it to them after experiencing a long bear market. But because, like I mentioned, Cameco, Orano, the joint venture operators of these two big mines in Saskatchewan that are absolutely vital to this industry, neither of them have pipeline projects in that jurisdiction to replace those mines. They've got licensed mills. They're going to need ore for that. Those projects aren't being developed right now. So they have to price into these contract terms, not just making a slight profit above what their production costs are today. They have to consider, well, not only the sunk capital from the bear market. So, for example, they had MacArthur River offline for 3 years, 3+ years, at $10 million a month of care and maintenance. And now they have to develop these assets, and assets that are in that area, in that jurisdiction, that will be able to provide ore to those mills. These are not $100 million mines. These are multi-billion-dollar mines, and they have to factor that into these terms. So there's a bit of a headbutting right now between, generally speaking, between the nuclear utilities and the legacy producers, the existing producers, in based on the terms that they are asking for. In the meantime, utilities are kicking the can down the road by procuring in small amounts in is any other way that they can prior to having to come to Cameco, Orano, Uranium One, Kazatomprom, and saying, "Okay, guys, we're ready to sign." That moment is coming. That we still have that in front of us, which is pretty exciting. But for now, things are moving in the right direction, despite the fact that utilities have not engaged in these large long-term contracts at these higher prices yet.
Yeah, really interesting. And it is a market, as you're saying, it's sort of not as much spot. It's more these longer term contracts, I guess, because of the life cycle of the facilities. And then from what I understand, it's actually uranium is a very small percentage of the cost of running a nuclear facility versus, and maybe this is not the same for, maybe it's more for new facilities versus old facilities versus like a, coal or gas. Those sort of fuels are taking up a much greater percentage of the cost versus uranium.
You're 100% correct. Yeah. Yeah. The overall fuel cost, and again, this is speaking generally because even in the US, you have two very different markets, regulated, deregulated, and then globally, there's totally different cost structures. But to speak very generally, the fuel cost for a nuclear reactor is about 10 to 15% of the overall operating budget. Uranium is about half of that. So let's say 5 to 8%, sometimes maybe a little bit more of uranium of the operating budget of the reactor is the source material for the fuel. And then the fuel itself is almost always less than 20%. But like you mentioned, like a gas power plant, it's about 75-80% of the operating cost is the gas itself. Yeah, it's in that way, it's very, very unique.
Yeah, definitely. So you mentioned before that sort of this year we haven't really seen uranium's been, I think it's for the year reasonably flat, but then actually the miners have gone up quite a lot. So there's been sort of a disconnect. So what do you think has been the main driver of that? Is that just a sort of catching up, or there's this expectation in the future that you know these utilities need to come and play?
Yeah, I think there's a bit of expectation. I think there's a bit of kind of looking over the valley, really, on behalf of investors, knowing what's coming. And when I say knowing, it's not theoretical, really. It's looking at the dynamics of the market. So the spot price is basically like the surplus disposal market. It's when a trader has a couple 100,000 pounds that they're getting from an offtake in Uzbekistan. They just want to dump it. They sell at whatever price is happening in the spot market. That's the spot market. Yes, it has some connection to the term market, especially the midterm market with carry trade deals, which are happening right now. So a utility, if you look at the printed, the reported from the price reporters, 3-year forward price at $94 a pound, if utility is going to sign a carry trade contract, which is basically where a trader will be fulfilling their uranium needs rather than the producer themselves, and the trader will then go and procure that material in the spot market and they'll hold it. They'll charge a fee for holding it and they'll calculate the capital costs and the profit margin. And so the carry trade will definitely kick in when you have the forward market significantly higher than the spot market. And that's effectively what's putting this floor in the spot price. So even though low volumes are being traded here and low volumes are being procured, we're not seeing it fall below, let's say, $75 a pound. And that effective floor that was in place due to the carry trade earlier this year was $64 a pound. So it's moved up $11 a pound, roughly 11 or 12 from April. And like I said, 3-year forward, 5-year forward, 94, 99, long term, $86 a pound is basically that printed price for the long term price is sort of the starting point for a negotiation of a base escalated contract. So that's what that price is. It isn't really the real market. And the price reporters are finally, they're finally speaking to this issue, which is okay, when you have the actual producers being willing to sell in these wide spreads between the floors and the ceilings at reference to the market 3, 4, 5, 6 years out from now, that's sort of an impossible, it's an impossible thing for them to be able to gauge what that actual price is of that contract, but it's not $80. So when the floor is 80 and the ceiling is 130, the value of that contract for the producer, the price they're going to be selling it at, is somewhere between those two prices, and they have to discount that. And it looks to us like they are starting to make an effort in capturing more of the real market price based on these negotiations. But to your point, the long-term market is where utilities procure most of their material. This year, it's been a little bit anomalous. So yes, more material has been signed in contracts this year than has been procured in the spot market. But in a typical year, utility buying in the spot market is 20, 25% of the total traded volume. This year, it's more than 50%. And part of the reason is that they're not wanting to go and sign these term contracts. They're doing what they can to buy elsewhere. So they've been buying in the spot market. They've been engaging in carry trades, and it's all smaller volumes. So a utility will come in and buy 100,000 pounds or 200,000 pounds in spot. They'll do a 300,000 pound carry trade deal, but they're not calling up Cameco and saying, "Give me 2 million pounds for 8 years starting in 2028." They're just not quite there yet. There's a few utilities that have. We would argue they're ahead of the curve, and I think that history will show that they were. And so far, every year that I've been following this market, the utilities that have stepped up in years past, when they did, that has generally been a very smart move for their utility. So that's all coming. That's all in front of us. And looking at the spot market, why the equities have acted in the way they have, like you said, are they looking forward? I think part of it is looking over the valley. I think the other thing is we've had a lot of great pro-nuclear headlines this year, with the Trump administration committing 80 billion to investing in the nuclear space, and actually taking ownership in some Westinghouse AP1000s. That's very positive here in the United States. We've seen multiple dozens of reactors life extended in the last 12 to 18 months around the world. There's a lot of momentum here for nuclear, and you can almost argue that betting on uranium here is somewhat of a contrarian trade, because nuclear is growing, the demand is de-risked, but we still haven't really seen that big move in the price. And that's something that it kind of has to happen. We're not going to see the market approach anything resembling a balanced market if prices stay where they are. So they're going to have to keep moving higher, at least another 25, 30% higher, I would argue, but they have to stay there. And like I mentioned, in this market, oftentimes in the bull markets, you see an overshoot, especially when you have the financial entities interested in cornering this market, and they're there. It's not just the Sprott Physical Uranium Trust and Yellowcake PLC in London. You actually have multiple other traders. Macquarie has been trading uranium for many years, but we see Goldman Sachs showed back up a couple years back, and then this year, Natixis and gosh, I'm forgetting the other one. So it's a very big commodities trader. Within the last 6 months, have both showed up to uranium. So they're all kind of looking at this to get a piece of the action. And when the financials get involved, it's kind of like all bets are off, because it's not a fundamental demand driver from an end user. It's a speculation, and it's a financial speculation can push things to levels that don't necessarily make sense for the industry. And that's not something we're betting on, but it is a right tail possibility that we could see more of that happening in the future.
Yeah, okay. Really interesting to see the dynamics of it. And there's obviously looks like there's going to be lots of demand coming online. At least, that's what people are saying. How do you model that into the future? Is it just, once they start being built, or do you have to wait until they get online? Because because it's one of those, as you said, very positive at the moment, lots of sort of political push, but similar to hydrogen in the past and other things, people can say they're going to invest all this money until they actually do it, until they build it. You never know.
Sure. So what we can look at currently is the existing operating fleet, and we can make either educated guesses, or we can make very solid presumptions on how long that reactor will be operating. So in most cases, we'll take the existing license, the life of that reactor, and we'll plug that into the model. In some cases, like in the United States right now, basically every single reactor that's currently operating and was or is set to shut down operations in the next 10 years is either has already been granted a life extension, a 20-year life extension, or has an application into the NRC to extend the life of that reactor, of which the NRC has denied zero of these applications. Even Diablo Canyon in California is supposed to shut down in 2029, 2030 for those two reactors. Already licensed for extension by the NRC, but going through bureaucratic channels. It's actually the only power plant, nuclear plant in the US that we haven't plugged in an assumption of a life extension yet, but it'll get extended. So we can take the existing fleet, make some assumptions on when it'll be operating to. And if you go out for a 5-year period, you can make extremely high confidence assumptions for the existing fleet, for the under construction. Beyond what's under construction, going out past 5 years, you have to start to plug. But going out 5, 6 years, half of the reactors under construction right now are in China. There's 71, 72 reactors under construction, and 35 of them are in China. China is reliably building new large reactors in 5 years. So that's something you can plug in. If a reactor started construction 2 years ago, it will be producing electricity in 2028. And so you can put that into the model. And if it gets delayed a year or accelerated a year, it all sort of kind of balances out there. With the other countries, you have to kind of usually give them a little bit more wiggle room in terms of construction. Once you get out past, let's say, 2032, you have to start using some plugs, which are to say, okay, what is China aiming for, and are they on pace to hit that? Okay, they're aiming for 150 gigawatts by 2035. Are they on pace to hit that? Yes, they are. So you can kind of look at what they have been saying and what they have been doing and extend that out a bit further. Once you got 2035 to 2040, there's kind of a lot of assumptions you have to plug in, but luckily for this industry and for this investment, the fuel demand for that period of time doesn't necessarily hit over the course of the next 5 years. With that said, if we do see shovels hit the ground for new reactors, for example, in the United States, like if we see an AP1000 start construction next year, we can say, okay, let's say that takes 8 years to build, which is a reasonable time frame. It's much slower than the Chinese, much slower than the Japanese when they were building, slower than the UAE that just built a 4-reactor complex. But still, I think it's doable, right? So they go out 8 years. Once that is actually under construction, especially for the nuclear part of the plant, so that usually what happens is you get an early construction permit, you start building the non-nuclear aspects first. Once they start actually building out the core, the company that's going to be operating that plant is going to start coming into the market for that fuel. So 2026 first shovel hits the ground, 2034 first criticality, just throwing this out there. They'll be in the market in 2031 or 2032. And it's like, okay, Justin, that's 7 years away. Why does that matter? It matters because that is this period that is very, very crucial for this industry where the market is utterly reliant on projects that haven't even started development yet being producing at the levels in their feasibility studies. Primarily, we're talking about NextGen's Arrow project. In their feasibility study, they claim that they will be producing 29 million pounds a year for the first 5 years. That's an enormous amount of uranium coming from a single mine. It will be, if they stick to that plan, the largest uranium mine ever built in terms of annual volume for those first 5 years. But everything has to go absolutely right with their permitting, which they probably will get at some point next year, probably in the middle of the year. And the construction timeline is 48 months. But if for whatever reason that gets extended, and has there ever been a uranium mine and mill built on time, on budget? Not to my knowledge. But they also can voluntarily produce much less than what's in that feasibility study. So this is a very, very important period of time, not only because the industry is reliant on these projects that haven't been built yet to come online on time, on budget, but also because that's the period of time the utilities are buying for right now. They're all covered for the next 2 years. Most of them are covered for the next 3 years. Half of them are covered for the next 5 years. You go out 7 years, and 10, 15% of global utilities actually have their needs covered for uranium fuel. So they're all going to be coming to the market to cover off the needs for that period of time over the next 24 months. And so when you have utilities potentially coming into the market for reactors that haven't even started construction yet during a period of time where we have a very tight supply situation, it accelerates it that much more. So all of this talk about building new nuclear in the West, it's exciting, it's wonderful. I'm here for it. Great. We don't model the demand yet until we actually start to see a reactor under construction. But if we do in the next 24 months, we could very well see demand for fuel for those reactors in this cycle. And so these things do matter. But as far as modeling out everything that's happening, we've got under operation currently, figuring out how long that will be producing, whether or not it's going to get life extended. Under construction, we can model with very high accuracy. And then once you get into the planned and proposed, that's when you have to start messing with plugs. But luckily, it doesn't really affect the investing thesis for the next, 3 to 5 years and then some.
Yeah, okay, really interesting. And what impact, I guess the hype is all around SMRs and the potential impact they have. Is that something that you model, or is that sort of more that plug in the future where you're sort of unsure of the demand?
We model for a very small amount of SMR demand that starts about 5 years from now and grows incrementally from there. Because we can recognize it is happening, but the demand for SMRs, the uranium demand coming from SMRs at this point is difficult to gauge where it will be 10 years from now. So it's very minimal in our model, and it's nothing, I think, for the next 4 to 5 years. We put zero, even though we've already seen some demand from SMR. So OPG is building I think it's 2 or 3 BWRX 300 GE Hitachi SMR in Canada, and they were in the market last year for uranium for those reactors. So once these things start to actually shovel in the ground, it usually is not a very long period of time after that process is underway that the uranium, at least the uranium part of that fuel cycle, fuel procurement does start to hit. So, and I think there's 80 to 100 SMR projects that are at various stages globally of being implemented. Some are under construction, like the BWRX I just mentioned, like TerraPower's Natrium in Wyoming, that's under construction. There's a half dozen more, but many, many more are in the works and are likely to be coming.
Yeah, it makes sense. So it seems like there's sort of there's only a few producers at the moment, and yeah, there's obviously Uranium Spot as well. So how do you, as an investor, how do you play that? Are you sort of very diversified? Do you sort of pick the specific names? What's your strategy?
Sure. So for the newsletter, we have two different portfolios. We have one called the Focus List portfolio that's more of a fundamental based buy and hold. That's something that we've done very well with. The outperformed the commodity by 2x since its inception. And that one tends to have more volatility because we don't do a lot of trading in and out. We'll definitely size down positions, size up positions, sometimes swap positions. But we have another portfolio called the Dynamic Model portfolio, and that's a basket of 5 highly liquid equities in the uranium space that we do much more trading on. So, for example, that portfolio is up 69% this year. It's outperformed URNM by almost 60%, which is URNM is the uranium miners, the Sprott uranium miners ETF. So, what we've recognized and what was the impetus for this trading portfolio was, despite the fact that we have a general overall long-term bullish bias, this sector will give us one or two deep sell-offs pretty much every year. And because we do so much work in the physical uranium market, in the actual fuel cycle, we understand who is buying, who is selling, what are the pricing mechanisms, et cetera, that when you have these either broad market or sentiment driven sell-offs, like we saw in early Q2, late Q1, early Q2 of this year, we had a huge sell-off. And not only did we see the spot price dropping, which obviously aided the sell-off in uranium equities, but we saw the broad market selling off with all the tariff concerns. And sentiment was the worst I've ever seen it since I've been following this market since 2017. Hands down, it was worse than COVID in April of this year. That gave us a huge opportunity to, with conviction, to put some money to work. So this trading portfolio, which is we've utilized very, very well this year. If you understand what's happening in the background, if you understand what's going on with the physical commodity, you really can trade this market with a lot of effectiveness. So that's how we treat our exposure to this sector. As far as me personally, it's very much aligned with the newsletter. I oftentimes will put on more leverage than I would ever recommend to anyone. only primarily with options and primarily when we have these deep sell-off troughs where it's like, I know this is going to recover because it has to. So this is sentiment driven. I'm going to put some money to work, which I did in April. It's been a killer year. Um, Looking forward at this point in time, I would say that there's a few of the mid and large caps that are either fairly valued or somewhat overvalued right now based on $75 spot. Based on where it's going, they're clearly not. But based on the market currently, I would say they're arguably a little bit overvalued or fairly valued. Nobody wants the small caps right now. Nobody wants these things, and they're getting thrown out with yesterday's garbage. And I think that a well put together basket of small cap uranium mining stocks of the quality small caps diversify. You do if this market has taught us anything in the last 7, 8 years, it's that going all in on your favorite junior explorer is probably going to make you lose a heck of a lot of money. So diversify even within this sector, diversify across sectors. I don't own only uranium. I own uranium. I own some offshore, some precious metals, some energy and battery storage plays, things like that. You have to be diversified. Uranium is my largest holding, but even within the uranium space, you have to spread it out. So looking at a diversified basket of small caps, I think with some patience, looking out over the next 3 to 5 years as a hold for those, probably going to be an extremely lucrative opportunity right here because even though URNM and these mid and large caps have done very, very well this year, a lot of these small caps are down and down relatively severely. And we're going into the next 2 weeks is going to be tax loss selling. So I would say keep your eye out for some severely undervalued junior exploration companies and even junior developer companies that the market just has not given a damn about this year. So that's something I'm looking at. And then, of course, just, I think there's a few names out there that are even in the large cap space that are severely, severely underappreciated and undervalued. And I can't give those names away. I apologize, but we're along those names and I talk about them often with the membership. But make sure you diversify. And if you want to trade the market, stay on your toes. Otherwise, just close your eyes for 3 to 5 years. You're probably going to be happy.
Yeah, great. Thanks for laying that out. But Justin, thanks again for coming on. Really appreciate it. My last question is, what is one message you want people to take away from our conversation?
I would say don't get too caught up in the AI data center story with this particular trade. There's definitely some connection between how the uranium equities and the uranium mining stocks have performed over the past 2 years based on where sentiment is for AI at the moment. We will see a wedge carved between those markets when we see a more robust price movement. And whether or not that narrative will move us around in the meantime, I would argue is it's relevant based on the performance of your portfolio if you're long this stuff, but it isn't really all that relevant in the grand scheme of things. What we're really talking about is the existing operating fleet and the reactors under construction. If you plug in nothing else beyond that, we're going to see higher prices incoming. No matter what happens with AI and data centers, if the capex stops right now, which is not going to, but if it does, we're still going to see these reactors operating because they're the baseload foundation of most grids, with the exception of maybe France, where they're most of the grid. Um, Either way, it's very, very de-risked based on demand factors that have essentially nothing to do with the growth of AI and data centers. Electrification is growing, to speak generally, even without that aspect of the story. So it's all there. The price is going to move higher because of those factors. And I would also say do what you can to learn about the fuel cycle and to inform yourself about what's happening in the physical market. Because not only does that tell you where we're at and where we're going, but it also can give you much needed confidence during periods of terrible, terrible sentiment and concurrent terrible equities performance. Because if you can trade a little bit around these moves and you can have confidence to put money to work when people are actually publicly capitulating and saying, F this, I'm out, I can't take this, this is the worst thing that's ever happened to me, and they're posting that on Twitter, X, those are the times you need to be buying. And it's hard to do if you don't have the confidence that can come from knowing what's happening with the commodity itself. And that's why we focus so much on it. That's why we put that information out there to our membership, because you have to know what's going on with the physical commodity. And unlike oil, while the uranium price for spot is updated intraday on various platforms that you can access for free, the nuances of what's happening in the market you cannot access for free, and most people are not wanting to pay for the services of the price reporters and the analysts that we do, and have the connections that we do as well, to be able to speak to just talk to the traders, to talk to the fuel buyers, to get all of the nuance in the physical market. But you have to at least make an effort to understand what's happening there in order to stomach the volatility and have the conviction needed to both buy and sell at sentiment extremes.
Yeah, great message. So thanks again. If anyone wanted to find out more about your work, I'm guessing Uranium Insider is the place to find you.
Yes, sir.
Great, perfect. I'll put that in the description below. But yeah, Justin, thanks so much for your time. Really appreciate it.
It's been a pleasure. Thanks for having me on.